We need 5 members to be present to have a quorum. And we do have Dana Weckesser, Marie Grant, we have Maria Pilar Rodriguez here, and Kat Rogers. We know that David Sharp is not able to make it, and we did not get a response back from Aika Luke or Singtonasia. So they may pop on, but we do have quorum, so we can get started if you want to kick us off.
Wonderful. Well, nice to meet all of you. Again, sorry for my technical issues getting on. I am glad to be part of the board and chairing the board in this meeting. So I think the first issue up is a motion for approval of minutes. Do I have someone to advance the motion?
I can make a motion. This is Kat.
Great. And Dana, I saw that you had also raised your hand, so would you second it?
Yeah.
Great. And then do we have to take a vote, Michelle?
Yes.
Okay. So do you want people to raise their hands? You tell me how you do it.
Yeah, if people could raise their hand, and then Cynthia will acknowledge it. She's got all the votes.
And again, if you're a board member only, could you just keep your camera on? Thank you. Okay, I have everybody. Thank you.
Great. All right. I think, Cynthia, do you want to talk about the public comment period?
No one signed up to comment this month.
All right.
Thank you.
Next is the board committee report. So policy committee and then standing advisory committee.
All right, so the policy committee did meet, and Michelle provided a federal update based on a recent convening between the state marketplace directors and the federal health policy players in DC. So obviously they're all paying close attention to the budget, to Medicaid, to cost sharing reductions, and whether these expanded tax credits will continue. And then our health policy analyst, Amelia Marcus, gave the committee an update on the 2025 legislative session. So one bill they talked about that went forward was the young adult subsidy, making it permanent and of course, contingent on available funding. In addition to that, another bill gave MHBE the authority to establish a larger state subsidy program with the intent to mitigate any loss of enhanced federal tax credits and to stabilize the market. MHB also received funding for outreach specifically to child care providers, and then there were some other bills aimed at protecting the Affordable Care Act at the state level. And then our Director of Policy and Plan Management, Johanna Fabian Marks, gave an overview of upcoming policy initiatives for 2025. She'll go into a lot more detail later on today for our board meeting, but she did provide an overview of recent federal proposed rule that would result in more burdensome enrollment process and concerns about lower enrollment, especially among a healthier population because of higher premiums. And then also discussed a reconvening of the value plan work group to design 2027 standard value plans, an internal work group to analyze administrative burdens in the enrollment process. She discussed improvements to plan shopping, including implementing an algorithm to recommend plans to consumers based on the preferences that they input. So that's pretty exciting. And then additional discussion about this outreach to child care providers, a partnership with the state data utility to improve race and ethnicity data completeness, and the launch of the small business enrollment portal. So that sums it up on the policy committee.
Great. Standing advisory committee.
I don't see that Aika has joined, and she was not at the Standing Advisory Committee meeting. So I'm wondering if she might be out of town and did not let us know that. Johanna or Amelia, would either of you be able to update the board on the Standing Advisory Committee meeting? And if not, we can pend it till when Aika's back.
Hi, I'm happy to provide a quick update. Just one moment. So for the Standing Advisory Committee, we heard from our Mimi Hyla-Gabriel on my team who leads small business work. She provided an update on development of the small business portal that Kat mentioned and its launch later this year. And then we also, I shared an update on the state and federal legislative developments. Michelle also updated on federal legislative developments in her executive update. And then I also shared a discussion around the state-based subsidy proposal, which we will discuss more today. And then I neglected to mention our first activity was to welcome our new 2025 members who introduced themselves. And I think that was the full agenda for the meeting.
Okay, Michelle, then I think it's over to you for executive director update if there are no questions.
Thank you. I'd like to first start by thanking Dana Weckesser, who's been on the board for 8 years. This will be her very final board meeting, and so we appreciate the 8 years of service you've given to the board. And coming your way, we'll put it in the mail tomorrow because we weren't in person today, and I'll see if I can, if you probably can't see it because you won't be able to see it, but I'll just speak to what it says. It's a citation, a governor's citation from the governor. And it says, the state of Maryland, governor of the state of Maryland, to Dana Weckesser, greetings. Be it known that on behalf of the citizens of this state, in recognition of your outstanding service on behalf of the Maryland Health Benefit Exchange, in appreciation of your success in helping grow enrollments by more than 60% during your 8 years on the MHBE Board of Trustees and helping build relationships with consumers, elected representatives, and sister agencies in both state and federal government. And as our citizens join together in honoring your dedication and contributions to ensuring access to quality and affordable health care for the people of Maryland, we are pleased to confer upon you this governor's citation. And it is signed by the governor, the lieutenant governor, and the secretary of state. So we'll get that in the mail to you, Dana, and we just want to, again, thank you and recognize all the work you've done for 8 years for the Board of Trustees. So if everyone could join me, we'll just give Dana a little round of thanks. Appreciate that.
Thank you, and it was my honor and pleasure.
Good. Well, that's the good news I wanted to share. So the less than positive news is going to be a whole bunch about what's going on in the federal government. So I did have Cynthia send out, which I think frames it very well. We've had just a flurry of activity over the last week primarily, but the last couple of weeks on what's coming out of the Energy and Commerce Committee, the Ways and Means Committee. As you recall, we've spoken before about what was in the proposed rule that came out and has had a lot of things for the ACA, different things that we commented on that we've been preparing for. Then when the Energy and Commerce Bill markup came up, they had codified a lot of what was in that proposed rule. So again, shortening open enrollment, eliminating the special enrollment period for those making less than 150% of FPL, requiring 75% of special enrollments to be verified, and on DACA elimination. So things that we have been preparing for, but now would be codified so that those savings could be realized earlier. So that was not a surprise. We were expecting that. What was a surprise was what came out of Ways and Means Committee, and a big surprise on a couple of fronts. One, there was very little notice in all of the the groups that we work with and the state-based marketplace folks that advise us. There was really not a lot of forewarning in what was coming out. So the Ways and Means bills came out Couple things, we saw that there's a lot of impact to legally present immigrants. It redefines legally present immigrants as who's eligible and puts a lot more constraints around who would be an eligible immigrant. And that will have impact on the ability to get cost share reductions, the ability to get premium tax credits. So just huge impact. Of course, DACA recipients were eliminated effective the first of the year. Also, very large impact for the exchange, pre-enrollment verification by August 1st annually. So the Ways and Means Bill really is looking for consumers to take an active role and verify all of their information and say, I want health coverage, which is a large singling out of people that get health insurance. Most health insurance, in fact, most automobile insurance and homeowners insurance, there are auto renewal features where you are auto renewed regardless. So this would be a huge administrative burden and more importantly, a big barrier for consumers. Also in that, in the Ways and Means was increasing the recapture of advanced premium tax credits. So there was, of course, you estimate how much income you're going to have, and that's what the premium tax credits are. When you reconcile them, if you have overestimated, we call it the clawback of those premium tax credits. So that's putting some tighter rules around that. And the biggest thing with most of these are they all are effective January 1st of 2026, which gives us very, very limited time to make the changes, to educate the community, to work with our carriers. One other item that we just talked about recently internally, and I talked with our insurance commissioner, Marie Grant, a little earlier about is it's an opportunity to create what's called a custom health option and individual care expense arrangement choice. This is for small businesses. It does make it Section 125 eligible. It is a 2-year employer tax credit for this program, and it's applicable for small businesses only. It does allow individuals to purchase health coverage through the exchange, which is a good thing, and that's a good thing with our new small business portal. However, what we have to evaluate further is what is the impact to the small group marketplace, and is there going to be adverse selection out of that? Is that going to impact the rates? So we'll be looking at that obviously with the MIA. And then we don't believe that if those employees came to the individual marketplace, they could get tax credits made available to them. So that's another area. So all of this to say, it's been a whirlwind couple of weeks. And of course, I haven't addressed anything on Medicaid, and Secretary Seshamani and her team have been going through everything on the Medicaid side and all the impacts there. We collectively, Maryland Department of Health, Maryland Insurance Administration, and Maryland Health Benefit Exchange will continue to really work collaboratively on communication around this, on education, working with the governor's office, working with our state legislators and our federal legislators. But needless to say, these bills will have a huge impact, not only on the exchange, but in the health coverage as we have gained for so many Marylanders. So I'm going to stop there. That's all I wanted to talk about today because it is has such a large impact on the exchange and on our state, and it's moving very fast. But I'm happy to answer any questions.
And I will just add, I think, Michelle, you tagged us at the Department of Health on the Medicaid front. I think between Human Services, MIA, MHBE, I think that we are all working together on what facts we have about what the potential impacts are and how we can make that public in a way that people can really understand, the real world impacts on real people. And Marie, you have your hand up.
Thank you, Madam Chair. Yeah, just to add on to that too, AC rate filings are due today in Maryland, and so, you know, once we go through a couple of things, we do publish those in a very transparent way. So I anticipate though that there will be a lot of conversation even after these initial filings, just given the level of the uncertainty in the federal action, with all of this swirl going on, and then potentially some actions, at the, you know, from the executive branch, but then also, you know, in good news, and we'll talk about later, the state subsidy, right? That'll help and will impact, likely have impacts on rates. So much more to come, but we should have a clearer picture over the next couple of weeks, at least in terms of rate impact, initial estimates of rate impact.
Hi, I have a comment. I have all the trust in the world in you, Michelle, your staff, the Department of Health, and the Maryland Insurance Administration to face this challenge and come through for the folks in Maryland. You did it for COVID. You're going to do it again. I have faith.
Other thoughts, questions, comments? Okay, hearing none, then we move to the next agenda item, which is the 2026 state subsidy. Johanna, I'll turn over to you.
Thank you. And so pleased to bring this discussion to you today. And then so we'll be talking both about potential program parameters for a state subsidy program for 2026, and then also regulations pertinent to the program. Next slide, please. So as you know and have heard from Michelle, the enhanced federal tax credits, which have boosted enrollment since they were passed in 2021 as part of the American Rescue Plan Act, related to COVID at the time, and then continued as part of the American Rescue Plan Act, will expire at the end of this year unless Congress acts, which is looking very uncertain and certainly not something that we can count on happening. Unless they act, assuming those enhanced tax credits do expire, we expect enrollment to decline due to that reduced affordability, people having to pay more out of pocket for their premiums. That's going to mean all of our enrollees who currently receive tax credits, which is about 198,000 individuals, will lose some or all of their financial support through the federal government through those tax credits. And we estimate that premiums will increase by an average of 68% for those individuals. So really a substantial out-of-pocket increase. Next slide. So
I'm sorry, can I interrupt you for 1 second? I'm getting a couple people saying they're not seeing my screen. Is everybody seeing the screen?
I see it.
I'm seeing
Okay.
it.
All right, thank you. I'm sorry, Johanna.
No, good to make sure folks can see it. So with, given this potentially very large impact on our market, the legislature decided to take action during this most recent legislative session and passed House Bill 1082, which establishes authority for the exchange to operate a broad state-based individual subsidy program to stabilize the market for plan years 26 and 27. So it's got 2 years of authority for the board to implement this program, and it's contingent on Congress not extending these subsidies, or you could also say if Congress acts to fully extend these subsidies, there's the bill is void, the exchange would not take action, and we would be very happy were that to occur. The funding for this subsidy program comes from the state dollars in our reinsurance fund. So it's the same pool of money that funds our young adult subsidy program as well. And our plan is that if we do go forth with implementing this broader state subsidy, we would not also operate the young adult subsidy program for the years that the broader state subsidy is in effect. That doesn't mean that we can't incorporate elements of the young adult subsidy into this broader program. We could still provide additional subsidy to young adults, but operationally for both the exchange and the insurers, it is simpler to have one single subsidy program rather than two parallel subsidy programs that are subsidizing, you know, the same people with the same funds. So wanted to provide that kind of clarification around our intent. And unfortunately, our state funding in the reinsurance fund is not sufficient to fully replace the lost enhanced tax credits. That would cost about $196 million per year gross. The net cost is less than that because we do receive additional federal pass-through funding for our reinsurance program by virtue of establishing a state subsidy program and keeping more enrollees in the market. But even with that net benefit, it's still too high a price tag for the state. Our current fund balance in the reinsurance fund, we anticipate at the end of this year will be about $450 to $470 million. So $200 million a year will eat into that very rapidly. So we have several partial replacement scenarios for the board to consider. Next slide. And so to lay out what we'll be doing in this presentation, I plan to discuss different scenarios we've modeled for partially replacing that federal tax credit. And we would like to get your feedback and guidance on thoughts around the scenarios we've modeled so far and any variations you would like to see us explore. And then we would release those for public comment and come back to the board in July to ask you to vote on a final version for next year. Normally, we would have the board formally vote on a proposed subsidy design. This is what we typically have done in past years with the young adult subsidy. We put that proposed design out for public comment, then come back to the board with the result of that public comment, our recommendation, and the board would vote on the final version. However, there's so much in flux at the moment, and we do anticipate having more clarity by July. And also, given kind of the short time frame we've had to do modeling, I don't think we've quite arrived at what our final recommendation would be. So we didn't feel like it was the best course of action to ask the board to select one proposed version to kind of bless today with a vote. So rather, we'll just planning to have a more general discussion and still go through a public comment period and come back to the board in July. In addition, as I mentioned, we have regulations to bring to the board that would, spell out and provide more guidance around the board's authority and the establishing the operations of this program. Those regulations I'll get more into in the second half of this presentation, but they're very similar to the regulations for our young adult subsidy program, of course, modified to remove the age limits for that program. And I'll get into that more shortly, but we will be asking the board to vote on those regulations. Next slide. And continue on. Okay, so the priorities for the subsidy as established in legislation are to mitigate that reduction in federal tax credits while maximizing enrollment. And of course, also considering the funds necessary to sustain the reinsurance program so that it continue to provide market stability through the end of 2028. The reason that date is there is because the reinsurance program is authorized under a federal waiver that is approved by the feds in 5-year periods. So our current waiver period extends through the end of 2028. we will have to reapply to the feds in 2027 to continue the reinsurance program after 2028. The state funding that supports the program, which comes from a 1% assessment on health insurance premiums in the state, is also authorized through the end of 2028. So again, we'll have to come back to the state legislature in 2027 to discuss the future of the reinsurance program, and if and how to continue that assessment to maintain the state portion of funding for it. So all that to say, the state will need to have a broader conversation in 2027 about, you know, the future of reinsurance and state affordability programs. So, but nonetheless, we do have the reinsurance program through 2028 and kind of need to balance funding for other affordability initiatives with also the funding for the reinsurance program. The last priority is to account for the many uncertainties going on coming from the federal government around what may happen with Medicaid, the individual market, and the small group market, as Michelle mentioned. That's very difficult to do, but of course we will do our best and will be flexible to adjust as the year goes on if we need to, and I'll mention more about that shortly. Next slide. So wanted to go through some background information before I delve more into the meat of this presentation. And I should note that we've been doing all of this work in close consultation with the MIA, and in particular, Brad Bobin and his team of actuaries there. So we'll also be inviting Brad to share some information, and he'll be on to jump in as questions come up that would benefit from an actuary's perspective. So, but back to this slide. So we'll be talking in this presentation about different impacts on people by their percent of the federal poverty level, which is a refresher, a reminder. Federal poverty level is an income measure. It varies based on your household size. And we'll be talking a lot about 200 to 400% of the federal poverty level. So wanted to translate that into what those actual incomes look like for a household of 1 and a household of 4, just so you can have that as a reference. So for a household of 1, 200% of the federal poverty level, or FPL, is a little over 30,000, up to a little over 60,000 at the 400% of FPL. For a family of 4, 200% of FPL is about a little under 65,000, up to almost 130,000 at the 400% FPL mark. So just a reference there for what we're really talking about when we talk about these percentages. Next slide. So this whole presentation is pretty weedy, so please bear with me. So when we're talking about these enhanced premium tax credits, the way the premium tax credits are determined is in reference to your income and the cost of a benchmark plan. And the federal government has established through the premium tax, this kind of schedule of income and tax credits, that people will only have to pay up to a certain percentage of their household income for the benchmark plan. Any cost above that is covered by federal premium tax credits, which are paid directly to the insurer and directly reduce the amount of premium that an individual or household has to pay on a monthly basis. So in the left-hand column and the middle column, you can see what those pre-ARPA or these enhanced tax credits, what those levels were. In 2021, before these tax credits were enhanced by Congress, people paid between 2% and up to 9.8% of their income for their benchmark plan. And if they were over 400% of the federal poverty level, there was no cap on what they could pay. They were ineligible for federal tax credits, and particularly for older individuals, they could be paying substantially more than 10% of their income for coverage. With the passage of the enhanced tax credits, people below 150% of the federal poverty level have no expected contribution, meaning they can get a benchmark plan, a silver plan, for essentially $0. And then the amount they have to pay scales up from there up to an 8.5% cap on expected contribution. And that cap applies to all income levels above 400% of the federal poverty level. So it removed that cliff where above 400% you were wholly ineligible. And it meant that no one, regardless of income, would have to pay more than 8.5%. But as you can see, at all income levels, it substantially reduced the percentage of income that someone would have to pay. If we go on to the next slide, we'll see some of how that has impacted our enrollment. One more background slide before I get there. So, sorry, continue forward one slide. Yes, thank you. No, back to the past slide. Thank you. Okay, we can pause there for a moment. So this chart shows who is currently receiving premium tax credits among our enrollees. And across the top, we've got it sorted by income as a percent of the federal poverty level. Along the left, we have age buckets. And at the bottom, we have totals for all ages within each of those income buckets. So you can see our highest enrollment is at the lowest incomes. We've got over 40,000 individuals in the under 150% and 150 to 200% of FPL buckets. And then in each bucket kind of thereafter, we've got around 20 to 30,000 individuals, including about 20,000 in that over 400% FPL bucket who were ineligible for premium assistance before the enhanced premium tax credits. Next slide. Okay, and then one more kind of background impact slide. This shows the impact of the expiration of the enhanced tax credits on a single enrollee. In the top chart, it's the amount they would pay in the increase they would pay per year in dollar figures for a benchmark plan. And on the lower chart, the increase, what that would mean as a percent of their income increase. And you can see from the heat map, the red indicates the most impacted individuals, and the green is the less impacted, but I would really caution and not say to think that the green indicates a low impact. For someone at, a very low percent of the FPL level, $200 a year or a 2% increase as a percent of their income can still be a very substantial impact. And again, these impacts are per individual. So they're cumulative if you have more than one person enrolled in coverage. If you have a 3-member household, that increase could be, $600 or more at the lowest income bracket. So again, just to give you a sense of what these increases look like for people on an annual basis. Next slide. And I will pause here, and Brad, if you're willing, I'll turn it over to you to talk through these various factors that we were considering when we have developed the scenarios to model for the board.
Sure. So the broad classes of considerations that we had was first the impacts on the market. We looked at the impact on the net premiums that was shown on the previous slide. The net premium impact varies by FPL and it varies by age. So those are the two parameters that we looked at as far as attributes of subscribers. And then we looked at the impact on enrollment. In most scenarios, we're going to be losing enrollment. That's the projection. The large increases are going to cause large losses of enrollment, and so and there's a model that correlates the losses of enrollment with the size of the net impact on your premium. So those with the lower net impact are less likely to lapse than those with the higher net impact. And finally, a very important but kind of wonky impact is the impact on silver loading. So silver loading is something that is done on our on-exchange silver plans to account for the costs of cost-sharing reductions. So these cost sharing reductions were originally funded by the federal government, but they've been defunded since 2018. And so we have to allow carriers to build in the cost of reducing cost shares for members. And so this has caused the silver premium to be higher than the gold premium. And this has led to an inflation of the subsidy, the premium tax subsidy because of this silver load. And the silver load is really driven by the percentage of members that you have in your pool that are eligible for the CSR, the cost sharing reductions. And that's everybody under 250% FPL. And really it's under 200% FPL where there's significant cost share reductions. So you know, our modeling focuses on those people because if we lose those people, it's going to decrease the premium subsidy for the whole pool, and it's also going to have an impact on our pass-throughs and our federal 1332. It's going to reduce those as well. So there's dual effects of reducing subsidies and reducing pass-throughs. The second thing we look at then is the subsidy program cost, you know, the direct gross cost of giving the subsidy. And so the third thing we look at then is the impact on the state reinsurance program. So everything we do with respect to the subsidy is going to impact secondarily the reinsurance program. The more people we keep in the pool, the more reinsurance costs there's going to be, but also the more impact, the more pass-through there's going to be. And we're also trying to balance a desire to have a balance at the end of the 2028 to give us some leeway in our state reinsurance program. All right, next slide. Did you want me to go through this too, Johanna, or
Go for it.
So we modeled several different scenarios. Kind of the base scenario we modeled was no state subsidy replaces the enhanced APTC. So that's kind of the worst case scenario of what's going to happen, how much enrollment are we going to lose if we don't replace the APTC. Then we kind of did the reverse of that, and even though Johanna said earlier that we can't afford to do so, we modeled out what would happen if we replaced the full enhanced APTC. So we did 3 sub scenarios under the full replacement scenario. We did a full replacement with no change to our reinsurance program. So we left the attachment point at 22,000, which was the planned attachment point for 2026. Then we also did a full replacement of the subsidy with increasing the attachment point to $30,000 and with increasing the attachment point to $40,000. Both of those would have an impact on unsubsidized premiums if we did them. We estimate it's about 0.6% of a premium impact per $1,000 increase in attachment point. So that raising it to $30,000 is going to have like a 6% increase. Raising it to $40,000 is going to have like a 12% increase on the unsubsidized rates. But you know, we've modeled these out as possible scenarios to see how the two programs interact and what that looks like.
And Brad, could you just give a quick 101 on reinsurance and the attachment point? I think I have that in a later slide, but it's probably relevant to do now since we're talking about it and we've got some new board members.
Yeah, so for our reinsurance program, you know, the reinsurance program fundamentally takes high claims out of the risk pool, and the state covers those high claims. And so there's 3 parameters that are defined to take out the high claims. So the attachment point is the point at which we start taking out claims. And so you have to have $22,000 of claims in a year in order for you to be eligible for reinsurance. It's not one claim, it's total claims in the year. So once you reach the attachment point, the state starts covering 80% of your claims. So that's the coinsurance rate. And so we have had a state coinsurance rate of 80% since the reinsurance program began. And then we have a cap, and we cover 80% up to $250,000. And then at that point, the carrier starts covering the claims again. And so we're talking about raising the attachment point, and that's going to reduce the effectiveness of the reinsurance program, but it's also going to save money. So that's why we're doing it, to shift money from reinsurance to the state subsidy. So the third scenario that we've modeled was to fully replace the enhanced subsidy up to 200% FPL. That's that cohort that's really important for the CSR loading. To phase out the subsidy to 250% FPL, and then to have no state subsidy above 250% FPL. And then finally, we did a fourth set of scenarios where we fully replace the subsidy up to 200% FPL. We phase out the subsidy from full replacement to 50% replacement between 200 and 250% FPL. And then everybody 250% to 400% FPL gets 50% replacement. And so we did several sub scenarios of this. We did one with no change to the attachment point, one with increasing the attachment point to $30,000. And then we also did two scenarios where we extended the subsidies to over 400%. So A and B, we only do the subsidies up to 400%. And then C and D, we do over 400%. All right, next slide, please.
And I think this is what Brad sort of largely covered. So as he was describing the reinsurance parameters, they've been pretty consistent since the program was established in 2019 for about 3 years. We just kept the same attachment point and then dropped 1 year due to some rate issues in the individual market, bumped back up to its $20,000 level in 2024. And then starting for 2025, we started increasing it by $1,000 per year. And the plan was to continue recommending to the board each year that we continue that $1,000 increase, which allows the program to adjust as there's medical trend and inflation, so that we don't have a static program size, which will slowly cover more and more claims in the market as, you know, costs grow, and $20,000 in 2025 is not as much as it was back in 2019. So the plan had been that $1,000 increase per year, but because of, you know, we're in sort of unusual circumstances, as Brad mentioned, we were looking at what does it look like if we try to rebalance some funding out of reinsurance, which by nature primarily benefits people who are ineligible for subsidies. It really brings down their premiums. People who are eligible for tax credits don't generally feel much of the impact of reinsurance because of the way their costs are buffered by the premium tax credits. So if we take some money out of reinsurance, it will have the effect generally of increasing what people who are not eligible for tax credits pay, which is generally the people over 400% of FPL. Even though they are eligible under the enhanced premium tax credits, typically their costs are below that 8.5% threshold. And so they don't actually end up receiving tax credits. So yes, increasing the attachment point moves money out of the reinsurance program, frees it up for the subsidy program, but has, you know, various effects on whose rates increase that we would then need to consider. I think that's enough for this slide, and we can go on to the next one. So here is the high-level overview of the impact of those scenarios as modeled, and this is done by the contracted actuaries. So we work with them. They have the model that they put these inputs into and kind of give us these results. But we work closely with MIA and those actuaries at Lewis and Ellis to understand the assumptions they're making, review the model outputs, and kind of refine and adjust. So I will touch on what this chart is showing and ask Brad if he has anything that he wants to add, and then we really welcome any board questions, of course, and feedback as we continue on this modeling journey. So on the left are the various state subsidy scenarios that Brad outlined, and then the second column shows those changes in the attachment point for each scenario, whether it's continued on as we had planned with the $22,000 attachment point for 2026 or an increase in that attachment point. The third column, the program cost, shows that total gross cost of providing these subsidies to individuals. So this is the amount we anticipate paying out to insurers to reduce people's premiums. That cost is impacted, as Brad mentioned, by both two factors, really. One, we may have higher reinsurance costs or lower, depends by having the subsidy in place. In most scenarios, we're going to have higher reinsurance costs, and this is relative to a scenario in which we have no state subsidy. So by keeping more people in coverage, more people are going to end up being eligible for reinsurance payments. At the same time, we're also going to get more pass-through from the federal government for having more people in the market. So the net cost takes into account both of those factors, and in general is a good bit lower than the total cost as a result of those increased federal pass-throughs. The next column shows total individual market enrollment under the projected scenarios. This is both on and off exchange, receiving a subsidy or a tax credit or not receiving anything. It's just everybody that we anticipate will be in the individual market. And the two scenarios I'll particularly point out are, I'll start with 2A. The full replacement scenario where we keep the attachment point at 22,000 as scheduled. In that scenario, you can see we anticipate having 298,000 individuals in the individual market. So about 300,000. And that's if, you know, we fully replace it. That's sort of the ceiling of enrollment we would anticipate for next year. Scenario 1, no replacement, where there's no state subsidy, is the other end of the spectrum. So we anticipate if we did nothing to replace the enhanced premium tax credits, we'd see enrollment drop by about 70,000 people, and that would leave us with about 228,000 individuals in the individual market. For each of the subsidy scenarios, we have some decline, and so in the next column over, we have some decline relative to that full replacement scenario, which is what we're using as the baseline to calculate these. So you can see that's a 23% decline in scenario 1 with no replacement. And then for each subsidy scenario from 2B below, you can see the decline is lessened. So we're looking at a decline of between 2 to 10% relative to where we would be if we fully replaced the premium subsidies. The next two columns, the net funding columns, show the total funding that we anticipate in our state reinsurance fund if we were to sustain one of these scenarios for both 2026 and 2027, as we're authorized to have the state subsidy program in the legislation for those 2 years. And then in 2028, if we had no state subsidy program and the enhanced premium tax credits were not in place. So I would focus more on the 2027 number because the 2028 number is a little bit of a worst case scenario. I think ideally we would have some continued subsidy support in the market, which would increase our pass-through funding and sort of not lead to the dire enrollment drop-off and loss of pass-through in 2028 that happens if, you know, the state subsidy disappears and there's no premium tax credits. So focusing on the end of 2027 number, you can see that we end in the black in most of these scenarios. And actually, let me just check something here really quick. I want to make sure, I'm sorry, that we're sharing the correct numbers here. So just give me one moment. Just one quick minute. I'll just have this pulled up here in just a second. Yes, okay, so my apologies, I should have caught this earlier, but this is not a little bit outdated. If I can take over screen sharing, I will share a more updated. Oh, okay, this looks good. Sorry. Okay, this looks good. So sorry for that. Okay, so no, this is correct. Okay, my apologies. We've been through a lot of numbers here recently. So you can see that with this, we end mostly in the black for 2027. We do end in the red for 2028 for some of these scenarios. Of course, we do not want to be in the red. That would mean we don't have funding to sustain the program. The amount that we end in the black varies by scenario. And I think what I would particularly draw the board's attention to here is both the program cost column, of course, the enrollment decline, and the net funding at the end of 2027. So you can see in the full replacement scenarios, there are some, even with the full replacement at $40,000, even at $30,000 for attachment point, we could end 2027 in the black. And we would have the lowest enrollment losses. However, that does require the state to be willing to write checks out to carriers for almost $200 million, which, as I mentioned, is quite a substantial sum. And that net cost is, there's a lot of assumptions going into all of these numbers around how many people will remain in coverage, how many will drop coverage. So and how much pass-through we'll get from the federal government. And that pass-through number in particular, we've gotten pretty good at estimating that over the years, but it still does tend to be a little bit off each year from what we expect. And we've, worked to refine that, but it is really a black box from the feds. So we can't typically get that number exactly right. And so if that pass-through number is not as we expect, we could see ourselves in, a more precarious financial situation. However, I will also point out that whatever we do in 2026 does not have to be what we do in 2027. If we pick one of these options and it ends up being more or less expensive than we anticipate, we can adjust course for 2027 when the board sets those parameters. So we're not truly locked into any one of these scenarios for 2 years. Additionally, I will say, I'm not sure that any of these scenarios is the one that we will bring to the board in July as the one we would ultimately recommend. As you can see, we've been doing a lot of iterating and we're going to continue to iterate. I think it may make sense to increase the attachment point to some level beyond 22,000 for next year, but perhaps less than 30 or certainly 40,000 would be a very significant rate impact to the unsubsidized population. So when we kind of look at what is the most efficient for the state in terms of us ending with the highest net funding, that would be scenario 4B. We end 2027 with $240 million anticipated still in the bank. We've got the 50% subsidy for everyone up to 400 and the $30,000 increase in the attachment point. However, that does leave people over 400% facing premium increases and losing the impact of the enhanced APTC. If we look at scenarios 4C and 4D, where we extend the subsidy to everyone with no cliff at the 400% FPL level, we do still anticipate ending 2027 in the black, but it is an approximately $30 million increase to add those over 400% FPL people. And we don't get any offsetting pass-through funding for them, which is why you see those net costs are higher. The additional point that I will note is, well, no, I will pause there and I will ask Brad if there's anything else he wants to add about sort of my summary of these scenarios or anything else he'd like to point out.
No, I think you summarized things well. I don't have anything to add.
So I think we would really welcome, as we continue on with our modeling, any guidance from the board around scenarios that they think are more or less appealing, any additional data points you would like to see in a future presentation, and any variations of these scenarios or completely different scenarios that you would be interested in seeing the projections for.
We have some hands raised, Dana.
Yeah. In the middle row where it says 2026 net cost, line 4B, there's a positive sign in front of the $19. Does that have extra significance other than that being in the black?
Yeah, so that means all the other rows are actually still a cost to the state, even after we take into consideration the reinsurance pass-through we would get as a result of running a subsidy program. Scenario 4B is the one scenario where we actually kind of, due to that design and the increase in the attachment point, end up making money relative to a scenario where we didn't have a subsidy in place. Brad, would you add anything to that?
Yeah, basically pass-throughs, the amount of extra pass-throughs exceeds the cost of the subsidy in this case, and we come out ahead.
Okay, so the positive sign still is confusing to me. So it's 19, what, million?
Million, yes.
Yeah, 19 million regardless.
So here we actually grow our reinsurance fund by 19 million by virtue of having this subsidy program, because pass-throughs, as Brad was saying, exceed the actual cost of the subsidy that we're paying out.
Okay, it's just not explained anywhere, so I'm just stuck on that positive. So the same thing is true above for 26 million pass-through, and below 68 million pass-through.
Yes, so maybe another way to describe this column is the lower the number.
I have a problem with the column. In number 19 on 4B 2006 net cost, there's a positive sign.
Right. It's not a cost. The state gains money from this process.
But not for the other areas. That just should be explained because it really threw me off.
Understood. Thank you for pointing that out.
Thank you.
I just had a quick question or two. So how does our state compare to others in terms of the attachment point rate? I mean, are we average or below average?
Our attachment point is low relative to other states that have state subsidy programs. MIA led a comprehensive analysis of other state subsidy programs about 1.5 years ago that we worked with them on, and And so, yes, we are at the lower end. We have one of the largest reinsurance programs nationally. We cover effectively about a third of claims in the individual market. But there is a positive relationship between the size of the reinsurance program and the amount of federal pass-through you get. So as the reinsurance program scales up, the federal pass-through covers a larger percentage of the program. So it is beneficial in some regards to have that larger reinsurance program. Anything you'd add, Brad?
Just from my recollection, the average attachment point was a little over $40,000. So, you know, even if we raise it as much as we've shown here, we would still be around average. But yeah, right now we're at the low end. I think we might not be the lowest anymore now that we've been raising it by $1,000 a year, but we're definitely on the low end.
Thank you. That's helpful.
Marie?
Thanks. Yeah, great presentation, both. Maybe I have a question and then just sort of wanted to make a comment about the future as we sort of flesh these options out. So the question, just to clarify, so your pass-through calculations that you worked with Lewis and Ellis on, those don't contain changes in the exchange program integrity rule that could lower our pass-through, right?
They do not contain any of the recently proposed changes in the program integrity rule or the reconciliation bill. So I will add that we are definitely aware we're going to need to continue updating this modeling to reflect how current law evolves, and if we need to hypotheticals around where the law may go. And even the, we're hoping we can have the board vote on a final design in July, but I put that final in air quotes. We really need something so that we can start building our system out and so that insurers can have some certainty around what to put in their rate filings. But we know that Congress, well, we don't know what's going to happen with the reconciliation bill, but something is probably going to happen, and Congress may take action on the enhanced premium tax credits towards the end of the year. So we may be revisiting this with the board as late as September or October to potentially change whatever we had proposed and had the board vote on in July.
Yeah. No, thank you. That's helpful because I just all of these, I guess to point out maybe for the board, the program costs, the net cost, the net funding left over are all very dependent on actions that maybe even aren't as much talked about right now at the federal level, but there are some changes pending that could really impact funding of subsidies and then how those are how that calculation goes into the pass-through, which is important for our conversation here. Maybe the second observation for as we're thinking about as a board decisions, just this is, I think, and Johanna and Brad, I think you both talked about this somewhat, but like, for example, for these full replacement options as we add in raising the attachment point, when we raise the attachment point, and Brad will keep me honest, we're raising rates for the unsubsidized population. Now, when the full replacement is there, I'm assuming that will put a max of 10% of income for those over 400% of poverty. So that's a buffer on one side. I guess
yes, it would contain the 8.5% max that the enhanced APTC.
Okay. Yeah. Oh, not even 10, 8.5. I keep on forgetting. Fantastic. So that helps, but I think some indication of how each of these options impact different buckets of our population will be really important, because I think underneath each of these options, even though we're seeing broad enrollment and costs, some portions of the population could see really high increases in costs depending on the option. So I think we all need to be eyes wide open on that as we make decisions.
Do other people have questions or comments? I'm cognizant of time. So I want to make sure that there is good discussion and people get their questions answered, because I know this is something that we'll come back to in July. Okay. Thank you. Next, we have the actuarial services contract, so I'll take it up.
I'm afraid we still have the regulations to get through, but those will be quick.
Okay, let's do that. Yes, and then we have a motion for that.
Yeah. So as I mentioned, we'll put a set of scenarios out for public comment, and you'll be hearing more from us in July on this. Next slide. And continue on. So we also need to establish regulations to govern the program. Of course, statute sets out very high level kind of parameters, and we need to flesh those out via regulations. So we're proposing a new chapter. It covers the structure, implementation, and eligibility standards for the program, as well as programmatic issues like document retention and audits, reporting, and a provision that the board set program parameters each year by the end of the preceding year, which we would always do well in advance typically over the summer of the preceding year, so that they can be available for rate filings when those are finalized in the fall. We're recommending submitting this as both a proposed regulation and an emergency regulation. So you can do those simultaneously. The difference is that the emergency process can, but does not always. It's a little bit dependent on the meeting schedule of the relevant legislative committee, but it can result in an earlier effective date. With an emergency regulation, you're still required. What that means is that if the relevant legislative committee approves, that regulation goes into effect upon the date of approval. So you don't have to go through the typical public comment period before finalizing it. However, for the emergency regulation to remain in place, you still have to go through that public comment period within 6 months of the emergency regulation being approved. So it doesn't get rid of the public comment period, it just allows you to delay it a little bit. So our plan would be to do both proposed so we can get that public comment period started, and emergency so that we can hopefully have an earlier effective date, and then we will continue on with the normal public comment process and finalizing the regulations following that public comment process. Next slide. We always put our proposed regulations out for an informal stakeholder feedback period. We post them on our website, and we share them with our standing advisory committee, which represents a broad cross-section of our stakeholders. We only got one comment back on these proposed regulations, and that comment suggested that we set up some more formal provisions around what we would do in the event program costs exceed what we had projected, and some mid-year change may be necessary to stay within budget. While we appreciate the spirit of these comments, we didn't feel that it was necessary to really define a public comment process for this mid-year change. It would certainly be our typical process to do public comment around any changes in a program parameters like these. But in the event of some sort of emergency budgetary situation where the board needs to take swift action, we didn't want to tie the board's hands around how they can react in some such situation. So while we would certainly endeavor to get public comment and contact enrollees, we did want to leave the board flexibility in how they react to any potential mid-year changes to the subsidy program. And of course, those conversations would go on in public board meetings, so that we declined to make changes to the proposal in reaction to that one comment. Next slide. So the timeline here shows the board vote today. The emergency regulations could be effective at some point after July 11th. That's when they would go to the relevant legislative committee and could be approved, but it depends on their meeting date and schedule. And if they were not to take action to approve them on the emergency basis, we would still be on track to have the board approve them as final in September for an October effective date. Next slide. And I think that's also just seeking the board's approval of this process.
So thank you, Johanna. Any questions from anyone? Do I have someone to advance the motion?
Make the motion.
Second?
A second. This is Kat.
And if people can raise their hands if they're in favor.
Okay, I have everyone. Thank you.
Okay. Now we can move on to the actuarial services contract.
Thank you. Good afternoon, everyone. I'm Becca Lane. I'm the Senior Health Policy Analyst on the policy team at MHBE, and I am here with my colleague Sherelle Green, who is the Procurement Officer on this proposal. So to give some background, this is not the first actuarial services contract that we will have awarded. We currently have one in effect, which ends on June 30th. Of this year, and the current actuaries that we contract with are responsible for all of the modeling that Johanna just presented on. So the scope of work with our actuaries includes not only that, but other modeling related to the reinsurance program, updates to the federal waiver that facilitates that program, affordability program modeling in general, design of our value plans, and any other actuarial support that we need. And so that scope of work is also what we were looking for in this next round of contracting. We switched from a 1-year base term to a 3-year base term for our contract. So it's going to be a total of 5 years because it's a 3-year base with 2 1-year renewal options. The not to exceed amount for each year is $200,000. And that's the same as it was during our last contract period. And so this time around, since it's a 5-year total contract, the not to exceed amount will be at $1 million over that 5-year period. We received functionally two bids that we were able to review. I believe technically we received 3, but one was non-responsive, which is a procurement term, meaning that it didn't have the information that we had requested or that we needed in order to be able to consider it, and then the offer didn't provide a response. So the 2 bids that we received were from Lewis and Ellis Incorporated, which is our current actuarial contractor, and also the Wakely Consulting Group. Next slide, please. We are requesting that the board today approve that our award determination to our incumbent, Lewis and Ellis. They offered the best financial terms. Their bid was under the not to exceed amount for each year, so $156,000 per year for each year of the 5-year total contract, and then the total amount of their offer is $780,000. We've been very satisfied with Lewis and Ellis's performance over the most recent contract period. They are flexible, they're responsive, and they are accurate as possible in their forecasting in this kind of inherently uncertain endeavor. So the highlights from our last couple of years with them include, in addition to all the modeling, parameter modeling that you just saw, from Johanna pursuant to the House Bill 1082 for the new subsidy program. In addition to that, they have been helping us with projections for the young adult subsidy and keeping an eye on our spending on that program, which is, we're always making sure we're not overspending our budget, modeling to support our value plans, analysis to inform the reinsurance parameters each year, actuarial analysis to support any changes we make to the reinsurance waiver. We had this past year sought approval to amend the waiver to allow undocumented immigrants to enroll. I'm not sure what's going to happen with that, but Lewis and Ellis did help us with our application to do that. And then also, any modeling and analysis that we need for legislative reports. And most recently, that was the Young Adult Subsidy Performance Report. And then also a report which showed a significant impact on retention of coverage from us covering the last dollar of people's premiums for people who are otherwise eligible for a $0 premium. There's still a little bit that they're responsible for. Lewis and Ellis helped us show that that coverage is very effective at helping people retaining coverage. So that is our request for who we would like to award the contract to. And on the next slide, I think we have
a question from Dana. Dana
Sure.
has a question.
Dana, you're on mute. I'm glad I'm not the only one who has trouble with my mute button.
Got it. I know we sometimes use MIA's actuarial services, and sometimes we use the folks that you guys are proposing we use again. How can you clarify again how we use them differently? Is it pretty clear? Yeah.
The MIA also uses Lewis and Ellis, and so it is very helpful when the MIA and the MHBE use the same contractor. It's not, it's not a requirement, but it is helpful for us to contract with someone who's familiar with the Maryland market, and that who have experience with rate setting in Maryland, and so Lewis and Ellis has that experience.
Okay, but sometimes we have Brad reporting. Is he doing the analysis? So when does Brad and his team at Maryland do it? And when does the Lewis and Ellis do it? Is it just whoever has time? I mean, and that divided up a certain way?
We often, we will all meet together, the actuaries, the MIA and MHBE, and we'll discuss anything relevant to both MHBE and the MIA, and anyone else is welcome to jump in with more.
Yeah, so Brad and the MIA doesn't typically do the analysis for us, but we do include them in all of our work with Lewis and Ellis so that they can provide actuarial insight and guidance to Lewis and Ellis as we're working together with them to model, because we work together so closely. But typically Brad and his team are not doing the analysis themselves. They're helping us to guide Lewis and Ellis.
That was helpful. Thank you.
Thank you, Johanna. I think I saw Marie Grant's hand as well, Commissioner.
Oh, what Johanna said, I stand down.
Thanks. Great. Okay, unless there are other questions, I think with that, I can hand it to my colleague Sherelle for the motion slide.
Good afternoon. At this time, MHBE is asking for the board to approve the actuarial support services to Lewis and Ellis for the contract-based period from July 1, 2025 to June 30th, 2028, with a not to exceed amount of $200,000 per year and $1 million total for the base year and the 2 one-year options. Thank you.
So do I have someone to advance the motion? Dana raised her hand. Do I have a second?
I can second. This is Kat.
Thanks, Kat. Okay, those in favor, raise your hand.
Okay, thank you.
Thanks, Cynthia. All right.
Cindy, I think the next slide is the IDIQ with me.
Yep, IDIQ is next.
Okay. This is a request to award out last year. This is a 5-year contract with a 3-year base, and we're currently in that 3-year base period that should start July 1, 2025. The next few slides will be a snapshot of our progress over the last 2 years. Next slide. Here are the task orders that we were able to fill. In 2023, we awarded, I should say, 110 master contractors. And out of that, we were able to have 153 resources that were able to fill these functional areas for us. Next slide. Here are some of the IT functions that we were able to use. PMO, enhancement, system support and maintenance. Next slide. Here is a NTE amount budget comparisons over the last 2.5 years. And if you look at this year's, we fell a little short, so that's a good thing. We were able to make some adjustments, so it won't be as much as it was for last year. Next slide. Here is the budget comparisons as well, and the distributions from the federal and state funding and our estimations of those costs and allocations. Next slide. Amount to approve, not to exceed amount is $34,550,000 with the federal financial participations of about $25,057,200 and a state participation amount of $9,492,800 for the IDIQ contract for FY fiscal year 2026, subject to availability of federal and state funds.
Sherelle,
We're on track.
Can we go back? Usually we do spend a little more time. I don't know if Venkat, you are on to talk about what we've done and how this ties into the IAPD. So Venkat, do you want to take that and maybe go back a couple of slides to show the work that has been done?
Sure, Michelle. Good afternoon, Madam
It's
Chair.
right here. Mm-hmm.
Good afternoon, Madam Chair and members of the board. Just to give an overview of this contract structure as well as the sourcing point of view from the exchange for the new benefit of the new members specifically. MHBE's technology, what does it mean by MHBE's technology? It means pretty much everything, the exchange with respect to connecting with the consumers or the stakeholders and partners. We have the consumer portal, which is interfacing with our 1.6 million, more than 1.6 million consumers, and our worker portal, which is serving all of our workers, call center workers, who use this every day to service consumer requests. And we have the mobile app end-to-end, one of a kind of a mobile app in the country. And we cater to Medicaid end-to-end, qualified health plan, dental plans, presumptive eligibility, etc. And we also have various other channels, including the recent live agent chatbot, AI-powered chatbot, secure messaging channels, and variety of technologies, recent technologies such as robotic process automation, AI-powered technologies. For all these technologies, the core staff, our predominant staff, come from this particular contract. Several years back, we used to have a large integrator who was developing the system as well as maintaining our operations. But over the last several years, we phased out of these large contractors and have built and inbuilt a team that's very tightly integrated with the exchange. As Cheryl pointed out, more than 110 vendors, out of which more than 30 vendors have a task audit. So this way we mitigated the risk of a vendor walking out and the exchange pretty much in a very dire situation. And also since we built this knowledge, our team managed by 13, plus recently hired 6 state staff, plus 153 consulting staff constitutes the entire IT. And we are able to, as noted here, we are able to do anything, pretty much anything an exchange can do in the country. And ours, as most of the board members know, is the leading technology in the country in this exchange marketplace. And we don't wait for typical state agency in terms of deployments, in terms of upgrading our systems, in terms of implementing policies. We are very rapid. Every month we have a release, which we call as a major release, consisting of more than 30-40 items, predominantly on policy and system enhancements. And every other month we have, again, major releases too. And we have weekly releases. We can have hard fix at any point of time, which our team is very agile, and we have expertise across any technology that you can name in the modern technology. We are not a legacy system, and unfortunately, we have to deal with some legacy system, be it MDH or DHS. However, our technology is cloud-based. The only component that we currently rely on in terms of hosting our infrastructure is the MD Think component. And even within that component, a majority of our lower environments and other functionalities have been brought to Exchange directly. So this is a very quick overview, but I'll be very happy to give a lot of details in our subsequent meetings. As Cheryl noted, a lot of these consultants come under the 90-10, so-called 90-10 or 75-25 funding participation. Cheryl, if you can go to the next slide, I can explain what it means. Maybe the next one, please. Yeah, here, all the development, system enhancements, project management operations, and special projects all come under the 90-10 federal funding participation, which translates to 88% of 90%, which is around 79% funded by the federal government and 21% funded by the state government. And all of our system support, maintenance, operations, security, all come slightly lower federal participation and increased state participation. And the small business health option, as noted earlier, we are working on an initiative that we intend to implement this year, which is 100% state-funded program. And we have another project called Unified Benefits, which is governor's initiative to combine several consumer benefit around Medicaid functions under one umbrella where consumers can use that one entry point to get various benefits. And we are part of that as well. And we have a small component of that as well. And that's also getting some funding. Last year, we got funding around $755,000, out of which we are moving some $400,000 into the next fiscal year in alignment with governor's plan on certain implementations. So totally, as you can see, around $34.5 million is a total IT resource funding estimate. And as Cheryl noted earlier, it's $1.7 million less than last year, as you probably know, due to various funding cut requests across the board. And previous slide, please. This is just to show from the funding participation comparison between last fiscal year to the current fiscal year and the next fiscal year, how the agency measures up. And in the last year, we implemented, as Michelle noted briefly, various technology initiatives in terms of enhancing our platform to the next 5 years, 10 years, and improving mobile options, and also a variety of AI-based technology implementations as well. We continue to work on these initiatives, and these initiatives are very tightly tied with the so-called IAPD, Implementation Advanced Planning document that we submit to CMS for funding the upcoming federal fiscal year. So in our subsequent meetings, I would be very happy to provide update on where we are this fiscal year and what are our plans for every quarter as well. Any questions? I'll pause for any questions. Okay, Cheryl, handing back to you.
I guess we can go back to the next slide, and the next slide where we request, that's Tracy, where we request the board to approve the budget that I mentioned prior. Thank you, Venkat. Very well said.
Yeah, Dana has a question.
Oh, Dana, do you have a question? I can't see.
Me
Yeah.
either.
Sorry. Yes, that 34,000, excuse me, the amount for the federal funds, do we already have most of that in the bank?
I wish, Dana, unfortunately, that's not the case. Actually, we are working on the implementation advanced planning document right now with our MDH partners, and we will be submitting in by the middle of June, anticipating to get a response by July. And usually CMS is pretty good in responding rapidly, so we are
Well,
providing our best case there.
are we hopeful that we'll get it? We'll get federal funds, or is it a big question mark?
I think we exchange has been very meticulous over the years, and we always had support from CMS regardless of the political party.
Okay.
And we had been proving our value addition for every scope item that we implement, and we have been very meticulous in demonstrating our execution as well over the years. And also we are serving as a model for a variety of other programs, and we always submit our updates and try to help other organizations as well. So I am I'm pretty hopeful.
Okay, good. And also congratulations to Dr. Venkat for getting his doctoral degree.
Thank you, Dana. I appreciate it very much. Thank you. Thanks to Michelle for my team for the continuous support. It's a very exciting journey.
Any more questions?
Okay, then I think, does someone want to advance a motion to approve this budget request? Dana's raising her hand. Do I have a second?
I'll second.
Kat is like the champion for seconding motions in this
Champion
meeting.
for seconding today.
Okay, all those in favor, raise your hand, please.
Thank you, everyone.
Okay, I have everybody. Thank you.
Okay. Next up, IT procurements. Venkat, I think this is back to you.
Thank you, Secretary. I will give a very brief introduction. I'll let our procurement manager take over. Informatica is one of our core software in the exchange where that connects the data with our application, where the data gets translated, extracted, and loaded into a variety of applications. This is one of the core pillars of our software. Over the years, we did look at other options, but as I noted earlier, we moved out of a lot of legacy technologies, specifically from IBM Data Stage, Oracle, and other products. And we settled on to Informatica over the years, and we find it wonderful software for us in alignment with our ID strategy. With that, I will hand over to Tracy.
Good afternoon, everyone. We actually issued an invitation for bid to actually renew our Informatica Power Center for a license period of August 1st, 2025 through July 31st, 2026. And we did only receive one bid, which we consider a single bid. And that vendor was Software Information Resource Corps, in the dollar amount of $290,722.61. Next slide. This slide basically shows the functional areas that Venkat referenced in regards to where we actually use the licenses for, and then it gives a breakdown of the state and federal participation of $191,876.92 for federal, $98,845.69 for state. Venkat, I'm not sure if you want to elaborate on any of the functions here.
Just to note that these are almost similar to the previous years, Tracy, and there are no significant change at this time. We are going for a limited number of years at this time as these technologies evolve, especially more infused with AI. We will watch closely, but at this time, these are pretty standard as years before.
Okay, thank you. Next slide. So MHBE is requesting the board's approval to award a contract. First, before I make the request, do we have any questions? Okay. MHBE is requesting award of contract to Software Information Resource Corps in the amount of $290,722.61 with a federal participation amount of $191,876.92 and a state participation amount of $98,845.69 to renew the Informatica Power Center subscription license for the period of August 1st, 2025 to July 31st, 2026.
Any other questions? Can I get a motion to approve?
I'll make a motion first this time.
Oh, who is going to replace Kat potentially for seconding?
Second.
Okay,
Second.
thanks, Dana. All those in favor, raise your hand.
Cynthia, did you see Maria put her confirmation in the chat?
I did, because I was
Okay.
wondering, I noticed, got a little worried she wasn't there, so I see that. Okay, thank you. I have everybody.
Okay. Next. Oh, that's it.
No.
No,
Cynthia?
more IT procurements. Oh yeah, that was just the first one. Sorry. Go ahead, keep going.
Thank you, Secretary. The next one is the EDB Postgres. This is our core database management system. Again, like other products, over the years, we moved out of legacy and adopted a cloud-based technologies, and EDB Postgres also evolved very well over the years. This is the technology we use to store all of our transactional data for Medicaid, QHP, and everything that Exchange holds. And we find it very good in supporting secure integrations, transactions, and partners like IRS, Labor Department, etc. So this product satisfies all of our needs, also very cost efficient compared to certain big box database vendors such as Oracle or Microsoft. So it's open source based technology. However, we have support, and this is one of the requests in terms of requesting for subscription renewal of the product. Tracy.
Okay, so we issued an invitation for bid to renew the EDB Postgres license for a period of August 28th, 2025 to August 27th, 2027. We actually received 13 bids in response to this particular IFB, 10 of which were responsive and 3 were not. vCloud Tech was the lowest responsive bidder in the amount of $450,794.48. Next slide. This is a cost breakdown again of the federal and state participation for the actual licenses that we actually get from EDB Postgres. Federal participation amount is $297,524.36, and the state participation amount is $153,270.12. Next slide. Are there any questions? Okay. MHBE requests the board's approval to award a contract to vCloud Tech in the amount of $450,794.48 with a federal participation amount of $297,524.36 and state participation amount of $153,270.12 to procure EDB Postgres subscription licenses for the period of August 28th 2025 to August 27th, 2027.
I'll make the motion.
Okay, and if there are no other questions, do I have someone to second it?
I do.
Dana seconded.
All those in favor, raise your hands.
Okay, thank you.
Okay, and then I think there's one more.
Yes.
Thank you, IT team.
Thank you, Madam Secretary. The last one today is the ping identity. This is technology used as centralized identity and access management for all of our consumer portal, worker portal, Salesforce, mobile apps, SailPoint, all of our identity management systems. It supports multi-factor authentication and the federation of security and a variety of risk analysis and various controls of secure gateway controls as well. The competitors in this area are Okta and Microsoft, Entra, and IBM. Again, like I said earlier, we moved out of those technologies and we're more agile and nimble in these areas. And I'll hand it over to Tracy.
Okay, we issued an invitation for bid for the renewal of the ping identity, formerly known as ForgeRock, for a license period of August 1st, 2025 to July 31st, 2027. We received 10 bids, 9 of which were responsive and 1 was non-responsive. Oxtel Inc. was the lowest bidder in the amount of $466,741.10. Next slide. This is a cost breakdown of the 2 licenses that we actually acquire from Ping Identity, with a federal participation amount of $308,049.13 and a state participation amount of $158,691.97. Next slide. Are there any questions? Okay. MHBE requests the board's approval to award a contract to Oxtel Inc. in the amount of $466,741.10 for 2 years, with a federal participation amount of $308,049.13 and a state participation amount of $158,691.97 to procure Ping Identity, formerly known as ForgeRock, subscription licenses for the period of August 1st, 2025 through July 31st, 2027.
So if there are no questions, do I have someone to advance the motion?
So moved.
Second? Dana? All right, all those in favor, raise your hands.
Okay, thank you.
I think that brings us to the end of our agenda. I know this was jam-packed. This is my first board meeting. I want to thank the team for all the work they're doing. I know this is very uncertain times that we are in. And I think it's a lot. It definitely is a lot for the board to digest, especially vis-a-vis the scenario planning that everybody is doing. I'm sure that there will probably be some developments before the next board meeting. We are all here, I think, to keep in close touch as things develop. And Michelle, I'll turn it over to you.
That's all for us for today. Thank you all for your participation. Dana, again, thank you for your 8 years of service. And Ken and Joanne, we look forward to having you on the board in official capacity June 1st. So thank you all very much.
Thanks, everyone. Take care.
Thank you.